Okay, welcome to Accounting 101 again. I don't know if you got a light dark thing, but again, the screen just lightened up. So I don't know, the camera had to adjust to the lighting room, I guess. Welcome to Accounting 101, where we are now going to embark on Chapter 10, which is, guess what? One of the easiest chapters in the textbook, dealing with how we account for investments. So investments are assets. Notice the last couple chapters we've done have focused on assets, starting with accounts receivable or cash, accounts receivable, and depreciable assets, plant assets, intangible assets, natural resources. Chapters 11 and 12, we're going to deal with current and long-term liabilities, and chapter 13, wrap up with equity, stock. So we've been first half of the semester, we're just learning the basis of accounting, the different types of accounts there are, the financial statements, the mechanics of how to write journal entries, uh, and I guess it started with inventories, chapters 5 and 6. We focused a lot on assets, and this is going to be our last chapter on assets. What are investments? Investments are when we buy a security, a financial instrument in another business. It can be a equity investment or a debt investment, meaning we can buy stock of another company's stock, or we can buy the bonds of another company. We're not going to get into partnership shares and collectible, precious metals and those kind of things. Just going to keep it simple here, talking about stocks and bonds, equity investment and debt investments. Okay, equity security and debt securities. That's how the book is going to refer to them. All right. Now, why would a company make an investment in another company? Well, there's several reasons. Maybe they have too much cash. Apple had over $500 million in cash on their balance sheet. $500 million. That's a lot of cash. And again, they use a lot of it for R&D, their own R&D, and other things. But if you're sitting on a mountain of cash, you should invest it, put it to work. You work hard for the money. You worked hard to accumulate it. Put it where you can get a return. And again, some people like to put their money in the bank. Well, now rates are inching up, but you're still not keeping. What do you get? 2-3% in the bank now on a certificate of deposit, maybe 4 if you can find a rare one. But inflation is still 7-8%, so you're losing purchasing power. So, just to tie up some idle cash so you get to maximize your return to the shareholders, owners. Another reason you might want to do it is exert company. And as we'll see later on, if you have a ownership interest between 20 and 50%, it's assumed you have influence. If you have over 50%, that means you have one half of the issued outstanding shares plus one more share. You have over 50%. You can control that company. Okay? Whether it's be a supplier or a supplyee of yours. So they start off by talking about debt security. Security is just another word for an investment. Whether you have a stock is equity security. If it's a bond, it's called a debt security. Okay. Notes, let's say debt security is an investment in notes or bonds payable issued by another company. So they're going to pay you interest, and then at a maturity date that's on the bond, they're going to return your money to you. More on that in chapter 12. It gets really interesting, chapter 12. I love chapter 12. Equity security is a security in stock of another company. So you're an owner. If you invest in a debt security, you're a creditor. If you invest in an equity security, you're an owner. You get dividends, you get a share of the earnings. If you're, just went bonkers on me. If you're a creditor, you get interest. You're the creditor, debt security, you're basically loaning money to the other company and they're paying you interest and then going to return your money, hopefully, if they don't go bankrupt. Okay. They talk about different types of government security, treasury bills, treasury notes, treasury um, bonds. Anybody know the difference? Is uh, uh, the maturity, the length of maturity. Bills are the shortest, I believe, under 180 days. Notes are midterm, and bonds are longer term. U.S. Issued. Some companies or individuals like to buy municipal bonds because their interest is exempt from federal taxation, subject to state taxation, though, unless you live in one of the 4 states that doesn't have an income tax. And okay, turn the page. Come on, there you go. And they talk about the reasons to do it. Okay, like any other asset, we've got to determine whether it's a short-term current asset or a long-term asset. So we say a short-term investment, which would be a current asset, or a long-term investment, which would be shown elsewhere on the balance sheet. Okay. Now, what makes it so is management's intention when they bought it. Management could decide we're going to buy tomorrow morning when the market opens, we're going to buy 100 shares of Walt Disney Company stock, and we're going to say 75 shares are going to be purchased with the intention of holding it long term, and 25 shares are going to be classified as a short-term investment that we're going to sell before the year is out, when we need some cash for stocking up for our busy season in the fall or whatever. So you could be buying stock, one block of stock at the one point in time, and divvy it up between long-term and current or short-term. Purely at the discretion of management to designate it. They can buy it for one and change their mind, so they're going to have to change it. Why is that important? Is it depends on how we account for it. There are 3 ways of doing this. There's called trading investments. Well, they talk about them in order here. They're going to talk about the debt securities first, and then they're going to talk about the equity securities later. So when we're talking about investment in bonds of another company, we can put it as a trading investment, which indicates short term. Held to maturity means we're going to hold them till the bonds mature. And then a default category would be the available for sale debt investments, which is ones that don't fit into the trading category, which is short term, and the held to maturity, which is long term. Okay, that's a default. Equity securities fall into categories of no influence, in which case they could either be trading short term or available for sale long term. Significant influence, that is if we own between 20% and 50% of the other company's stock, and there's no evidence to the contrary. It is assumed we have influence over them, and a different way to account for that. And finally, if we own over 50% of the company's outstanding stock, we have control. We have a controlling interest. We're the parent, and they're a subsidiary company. And the reason that is if we have half plus one more share, we can control the board of directors. And if you can control the board of directors, you control management and the company. And there's a summary there on Exhibit 10.1, types of investments. For debt securities, we have trading, held to maturity, and available for sale, and the definition. And then with equity securities, we have no significant influence, and control. Yes, it really is that easy. I wish turning the pages in this electronic textbook were that easy. Let's give it a go. I don't know if it's a book, or maybe it's this computer. The touchpad's not that, or not very sensitive, or there's dead spots in it. Purchase of debt securities. Like any other asset, it's what we pay for it and any associated fees. Now, bonds, what we have here on page 10-5 is assume Smart Touch Learning has excess cash to invest and pays $100,000 to buy $100,000 face value, 9% 5-year Neon Company bonds. Usually you would say Neon Company nines would mean. And if you, a lot of times in the security industry, they'll quote the price as a percentage. So, you bought it at face value, it means it was bought at 100% or bought at 100. If you paid less than face value, then you would, 95%, you say, you purchase at 95%. And again, we'll get into more of that in chapter 12. From the issuer standpoint, it's more of an issue than when you're the investor. Okay. The bonds pay interest on June 30th and December 31st. So you just debit an asset account called held to maturity debt investments because the intention was to hold them long term, and you pay the cash. And there's the entry right there. $100,000 debit, $100,000 credit. Debits and credits have to be equal. Yep, even in chapter 10. And it's time to pay. Okay. When the interest is paid, we are going to debit cash and credit interest revenue. Pretty straightforward. Now, you say, why is it? They're 9% bonds. $100,000 worth of bonds should be $9,000 interest. Yes, but they pay the interest twice a year, so half of the $9,000 is in December 31st. The other half is on June, whatever they said, June 30th. So, let me go back a page here. Is that the only thing on this page? Come on. I guess that's it. Disposition at maturity. We get our $100,000 back. So we get the cash and we debit cash for the $100,000 we get paid, and we surrender the bond to the company. So the investment, the asset account, held to maturity debt investment, is credited. Other accounting issues for debt investments. Well, let's see what we got here. If it's sold at a premium or discount, what does that mean? Well, it means if we sell it at a premium, if we bought it at a premium or a discount. If a discount would be when we bought it for less than maturity value. A premium is we're paying more than the maturity value for the bond at the time we purchase it. Now, as we'll see in chapter 12, the price of bonds is dependent on the market rate of interest. The bonds have a stated rate of interest printed on the bond. The ones we bought were 9% bonds. If the market rate of interest was 10%, people are going to go to the market and buy and invest. So a company that sells 9% bonds would have to discount the bonds by an amount that would make their effective yield equal to the market rate of interest of 10%. So we would buy them at a discount, something less than $100,000. If the bonds paid, did I reverse that? We bought 9% discount. Oh, yeah, okay, market rate was 10%. Now, if the bonds have a stated rate of 9%, as the example in the book for Smart Touch Learning, buying those from Neon Company, if the market rate of interest was 7%, what do you think Neon's going to do? People will be clamoring and standing in line to get a 9% return on their bonds because the market rate of interest or all the other investments are 7%. So their interest rate is greater than the market rate of interest. People will be standing in line. What's a smart business to do? Charge something above the stated price, something above the market maturity value. And that amount would be the premium, and that premium would bring the effective interest yield down to the market rate of interest. Again, more on that in chapter 12. It's really neat. Brings everything back into equilibrium. It's going down the page now, but there's no hold on page 10-6 for them. All right, let's get over to 10-7. How are investments in equities security accounted for? Well, when there's no significant influence, come on. I don't know why this won't drag down. There it goes. Okay, purchase, whatever we pay for, market value, right? $26.16 per share. We got 1,000 shares, so that would be $26,160. So that goes into an asset account called equity investment. And if you want to note it, you can put in parentheses or something, yellow corporation. And, I look at that entry there. They say purchase investment in stock. Now, the memo, if you write a memo, should tell you something about it. It should name the company. Say, when you have stock as an owner, you get the dividends paid to you. Cash is debited. Dividend revenue, dividend income, either one would be credited. You sell the shares, you get the cash, you debit the cash, you bought, what do we pay for them? $26,160. We sold it for $25. And we only sold 800 of the 1,000 we bought. So we sold it at a price above what we paid for it. So you see the cash we're selling it for, 25,000. 800 shares at $26.16 would be the basis of what we paid for the 800 shares. Not, we're keeping 200. So the amount we're getting is higher than the amount we paid for those 800 shares. So the difference is a gain. If it would be a lower or a negative number there in that computation, you would have a loss. They showed the entry underneath. Cash is debited for 25,000. The stock is taken out at its basis, $26.16 a share times 800 shares, or $20,928, and the difference being the gain of $4,072. And yes, that would be subject to tax. And as I said there in that bubble, it would be shown under the other income and expense items on the multi-step income statement. Oh, wow, it took 4 or 5 seconds for the page to turn. Okay, when we have why is this saying, did I skip a page there? Turning the pages, did it turn 2 on me? I got to go back a page. So when you don't have a controlling, or when you don't have influence, it's called the fair value method. Yeah, I went from page 8 to page 10. No, it's still on page 8. It just when we have significant influence over a equity investment, that means we have between 20 and 50% of the voting stock we own. Without evidence to the contrary, it is assumed we have significant influence. How could we own, say, 40% of the company and not have significant influence? Well, if some other party owns 60%, they would have control. So if they have control, we have little or no influence. All right. So when we have this situation of between 20 and 50% ownership, we have to use what is known as the equity method of accounting for an investment. The purchase, again, straightforward, whatever we pay for it. You debit the asset, equity investment, name of the company. Here it's Klein Incorporated. Credit cash for $400,000. I guess Sheena Brights is doing really good. Started the business back in January with $30,000. Now she has $100,000 in investment and $400,000 in this company. Now, when you use the equity method of accounting, it's pretty simple. When we have income as an owner, we get a share of that income. So whatever ownership portion we have, then they say we have a 40% ownership in Klein Incorporated. So it says here, Klein Company paid a cash dividend of $50,000 on June 30th, and we pick up 40% of that 50,000. Okay, so 40% of 50,000 would be 20,000. So we get cash at 20,000. But what's happening? That company, Klein and Company, had $50,000 in cash. Well, they had more than $50,000 in cash in their cash account, and they decided to pay shareholders $50,000. They decided to pay out $50,000 of their cash to shareholders in the form of a dividend. So what does that do? Is the company larger, smaller, or the same size after the payment of the dividend? I'm waiting for you to think about it a little bit. And while you think, if you answered it, good. If not, I'll tell you the answer. The company is smaller because it gave out $50,000 of dividends. It has $50,000 of less asset. So if you think of a ball, a beach ball, the company was this big. When they pay out the dividends, the company gets smaller. Well, we own 40% of the company. After they pay the dividends, we still own 40% of the company, but the company is smaller. So what we need to do when they pay dividends, we're going to pick up the cash with the debit to our asset account called cash, where we're going to simultaneously reflect the fact that our ownership in the company is smaller by $20,000, our 40%. Okay, the company is smaller, so our investment is reduced by the amount of the dividend. Now, how does that affect us? It doesn't change our net worth one penny. Why? Does it matter if the company didn't pay the dividend? We have a claim on 40% of that $50,000. It's in the cash account. They pay it, we get $20,000. Does it matter if we have $20,000 in that claim on the company when it's in the company's checkbook or bank account, or if it's in our bank account? The only difference is that when it's in our bank account, we can spend it. We have control of it. When it's in the company's, hopefully this is making sense. It's, again, think of it as a beach ball that's getting smaller. When they pay the dividends, the asset goes down, so we have to reflect that our 40% is now 40% of a smaller company because of the payment of the dividend to shareholders. So we're going to reflect that in the asset account, equity investment. So, I mean, look at that entry. Cash is going up $20,000. Cash, an asset is going up $20,000. Equity investment, an asset is going down $20,000. So we don't have a gain or a loss. It's just a difference of whether the money is in Klein Company's account or if it's in Smart Touch Learning's account. Now, when Klein Company has a net income or a net loss, it's going to either make the company bigger or smaller, and we still own 40% of the company. So we have to reflect that in our investment account. In this case, they said Klein Company reported net income of $125,000. Well, how much of that is ours? 40% of it, or $50,000. So we're going to increase our investment because our 40% is now 40% of a larger company because they had net income. So we're going to debit the equity investment in Klein Company, $40,000, with an offsetting credit, $40,000 revenue from investments. Okay. Perfect logical sense because it's all predicated on the accounting equation. When Smart Touch Learning decides to sell its investment in client, it will need to determine whether there's a gain or a loss. Okay, so we're going to sell 10% of our stock. We paid 40,000, or I'm sorry, we paid 400,000 for it, so 10% of that would be 40,000. And let's see, we're getting 40,000 for it, but let's see what the effect of it is. Well, we paid 400,000 for it. We reduced that equity account investment by the dividend of 20,000. That would have been us 380,000, and then we picked up the investment income of what was it, 40,000? Yeah, I'm sorry, 50,000. So that puts us, our investment in the company is 430,000. Oh yeah, they show it right there under that entry on page 10.9. Initial investment 400,000, $20,000 reduction for the dividend payment. Of course, our cash went up 20,000, and then we picked up, increased the asset equity investment in client company by our share of its net income of 50,000. So we have our total investment in client company is $430,000. We're selling 10% of that, so we're giving up something with a book value of $43,000, and we're selling it for 40,000. So we're giving up something for 40 that's worth 43 on our books, and we're only getting 40, so we're going to have a loss of $3,000. And then they show you the entry there on page 10-9. Cash gets debited for the $40,000 we're selling it for. The asset equity investment in client company gets reduced by $43,000, or 10% of our balance in our equity investment account. And the plug figure of $3,000 debit means we had a loss on the sale. So you put it in a loss account. Okay, cross my fingers and try to turn the page. Okay. The third possibility is when we have a controlling interest. We own more than 50% of the company's voting stock. We have control. In this case, what we do is we file consolidated financial statements. What that means is we pick up our share, our pro rata share of their assets and liabilities and equity accounts on our balance sheet. We pick up our pro rata share of their revenues and expenses on our income statement. Okay. And the company, if we own more than half the company, we're the parent, and that company is a subsidiary. Now, a lot of times, if you own 100% of the other company, you're called a wholly owned subsidiary. Okay? Regardless, once you have control, once you have over half of the voting stock of another company, you use consolidated financial statements to report the investment. You pick up all their accounts and merge them into your accounts. Okay, how are these reported on the balance sheet? Now, come on. Trading investments, a fair value method. What we have to do, since investments are changing constantly every day during the day, going up and down in the marketplace, we want to reflect that in our investment account. We want to reflect the increase or decrease in the market value of our investment. So what are they telling us here? Smart Touch Learning reported trading and debt investment of $26,160. They concluded that the market value of the trading debt investment had decreased to $24,000. So the company has an unrealized loss of $2,160. If they sold it, they would have a realized loss, but they didn't sell it. They still had it, just the fact that it went down in value. Well, how do we show this? Well, we have to use a valuation account. Okay, so we have this new account called Fair Value Adjustment Trading. So we know it applies to the trading debt investment account. Now, our cost is maintained in that asset account, trading debt investments. Okay, that's the bonds we bought, $26,160. Okay. The drop in the value, and since the market price, it went down, to 24,000, we have to reflect that difference in this valuation account called fair value adjustment trading. Now you can see it there on page 10-11. We have the trading debt investments with the $26,160 balance. That's what we paid for them. And we have this fair value trading adjustment account right next to it, a valuation account. Again, this fair value adjustment account can be either an adjunct account or a contra account. Adjunct adds to the value, contra will reduce the value. Here it's reducing the value. If the bonds went up in value, we would have a debit in the fair value adjustment account to bring it up to fair market value. So the trading debt investment account plus or minus the balance in the fair value adjustment account will equal the fair value of that investment at the end of the year. Okay, so here we have a debit, excuse me, we have a debit in the investment account and a credit in the fair value adjustment, so you net them. So it's going to be a reduction, unrealized holding loss for the trading category. If it went up in value, it would be a debit, so it would increase it, and you would have a unrealized holding gain. And there would be a debit to the fair value adjustment account. Come on. In this case, the fair value adjustment account has a credit balance and is considered a contra account and is subtracted from the trading debt investment account to determine carrying value or book value. If the account has a debit balance, that is, if the fair value adjustment account has a debit balance, it is considered an adjunct account. It adds to the trading investment account. Excuse me. I don't know if that'll help or not. I don't think it did. So then we show the fair market value of that account on the balance sheet. Trading investments at fair value. Cost in parentheses, but the amount listed on the balance sheet there is $24,000. The fair market value at the end of the year. The income statement is going to show a trading loss, an unrealized holding loss. Okay. When it's disposed of, we're going to realize any holding gain or losses. Okay. Now, if we have a available for sale debt security, it's handled very much the same way, except let's see the particulars here. We had a available for sale debt investment of $60,000, and the market value is $64,000 at the end of the year. So we're going to increase our investment is worth more. We haven't sold it, so we have an unrealized holding gain. So it's a fair value adjustment debit of $4,000 and an unrealized holding gain available for sale of $4,000. And they show you the presentation on the balance sheet. So notice we're giving a lot of information to the people that are using this information to make decisions. We're showing in the fair value on the balance sheet in the column on the right, and in the parentheses, we're showing them our cost basis in that asset. $60,000 cost, currently worth $64,000. Now, unlike the trading securities where the holding gain or loss is reported in the income statement, when we have an available for sale debt security that increases or decreases in value, if it's an available for sale category investment, the gain or loss is shown as a component of equity called other comprehensive income. Now think about it. Go back to the trading debt security. The loss was shown on the income statement. What happens to that? Well, in the closing process, that gets transferred to the retained earnings section of the balance sheet, an equity section of the balance sheet. Here, it's not going to go on the income statement. It's going to be a direct increase or decrease in the equity section in a special equity account called other accumulated other comprehensive income. Now you say, well, what's the difference? Both ways it ends up in the equity section. When it's in retained earnings, it's available for payment of dividends. When it's in the accumulated other comprehensive income section of the equity section of the balance sheet, it is not available to be distributed in dividends. And the theory is, in the trading category, it's a short-term investment, so it's going to be realized sooner than later. In the available for sale category, we're not so sure it's going to be sold very quickly, so we're going to prevent it from being available for dividend payment. So other comprehensive income, or comprehensive income, is a company's change in the total stockholders' equity from sources other than owners' investments and dividends. And again, it's not in retained earnings. It's an equity account, but it's one that is restricted, that it cannot be used for the payment of dividends. And they have a special statement there. They're going to show it. All that does is expand on the line item from the balance sheet. It explains what's on that one line item. Accumulated other comprehensive income. And when we sell them, we'll have a realized gain or loss, depending whether we sell them for more or less than we paid for them. Held to maturity debt investment. Again, we're going to record it at what we paid for it, and depending on the maturity date, it will be reported either as a current asset if it's in the year of maturity, or if it's not in the year of maturity, it'll be a long-term investment. Because by the name, held to maturity, the intent is to hold it till its maturity. Interest will be posted debit to cash, credit to interest income, and reported on the income statement. Come on. Wow. Just went up to page 1018 from 1010. Oh, come on. Back. Oh, come on. Please say a prayer for me so I don't throw this computer against the wall. Okay, so with the held to maturity, we're going to report them at what we call amortized cost, which if we paid face value, there's no big deal. If we bought them at a discount or a premium, we're going to have to amortize the discount or premium, and it's going to adjust our interest income. Not the interest paid, the interest income. Page 13. Come on. Why am I missing page 14? Skipping right over it. 13. Yeah. We already talked about this 10:15. All right. Exhibit 10-3 summarizes the chapter in a nutshell. Down the left-hand column, it talks about the different types of security, trading debt investments, held to maturity debt investments, available for sale debt investments, and then the last three are your equity investments, no significant influence, and controlling interest. And then they tell you the accounting methods to use, and then how to present them on the balance sheet and the income statement. They talk about what type of investments does Berkshire Hathaway have? They have all kinds. They have debt and equity, and they probably have a bunch of other. And they have some that they influence, some that they have no influence, and some that they control. So they ran the whole gamut of availability. Let's see if I can get this page to turn. It went backwards. Something's wrong with these ways these pages are numbered. With me here, flipping between pages, or trying to. Okay, no, I guess that's 1060. No, I didn't see 1017 here. I click on it and we go to 1015. That's got to be a typo. Finally, it looks like we're at the end of the chapter. They're going to introduce a use of the rate of return on total assets to evaluate business. As our authors are accustomed to doing, they introduce a new financial ratio to us at the end of the chapter. This chapter is called the rate of return, or simply the return on assets, the rate of return on total assets. Two ways that a company can use this. Okay, it measures the company's success in using assets to make a profit, to earn a profit. Okay. It's calculating by adding interest expense to net income and dividing by the average total assets. So the total average assets would be beginning of year, end of year, divided by 2. Very similar to what we saw the net sales, how efficiently they're being used. This is how profitably they're being used. Interest expense is added back to net income to determine the real rate of return on assets, regardless of how they finance those assets. There's the calculation down there for Kohl's company. Net income, add back the interest expense, divide by the total assets, and it says 8.2%. So they have a return on total assets of 8.2%. That's a lot better than you're getting in the bank account at 3.5 now. Now that 8.2% is purely on their net income. It has nothing to do with how much is the rate of return on market appreciation, if the value of your investment went up or down. Okay, and this should be the end of the chapter if I can get the page to turn to page 18. Yes, we're at the review. Okay, so we'll be seeing you when we do the video for the solutions to the assignments. So read the chapter, watch the video, read the chapter again, watch the video again. And again, if you need to do it a third time to get a good understanding of it. So signing off for tonight.